Welcome back to You and Your Money. We're discussing investments. My guests are David Shapiro and Lutanda Mzilikazi. If you'd like to email, you can send your email to info@anchorcapital.co.za. David, do you think markets have, we know interest rates are going to come down. We just don't know when. But do you think markets have priced a lot of this in?
A little bit. We're going in for good markets.
Yeah.
When it actually happens, animal spirits start to play out, and the market will continue. So I don't think you should put too much intellectual effort into trying to understand inflation and understand all of these things. Markets will go, when interest rates globally start to fall, equity markets will pick up. And what's also interesting is the algorithm says if the dollar comes under pressure because rates are going to start going down in the US, the rand will improve, commodity prices will go up. That's all part of the equation. So you don't have to be clever to understand what's going to happen. And I think we're in for a good second half.
David, you just need AI.
Well, AI, yeah. I use it all the time.
Do you?
Yeah, I know you're going to ask questions here, but you see on radio, I could go into my AI and say, here's the question. And as you're talking to me, I type it, and it comes out with a perfectly balanced answer for me.
Well, my grandson who's 12, one of his classmates got a most wonderful mark for composition, and the teacher called him and wanted to know what do these 3 words that he used mean.
Oh no!
He didn't have a clue. So it just goes to show I don't know what they're going to be doing. David, Pauline Mshlanga says, can you explain? No, this one's for you. Can you explain the differences between active and passive investment strategies and comment on the advantages and disadvantages?
Sure.
I'm throwing this one to you.
I love it. And I think it actually highlights the question that I get from investors quite a lot. So let's start with passive. So with a passive investment strategy, you're simply investing in the market. So let's say, for example, you want exposure to the global equity sector. You'd invest in a passive that gives you that allocation. The advantage
passive being a fund.
Passive is a fund, yeah. You can get it in the form of a fund. So one of the advantages which I think most investors actually like about investing passively is the TIC. So it is quite low cost. And over the last 10 years, actually, passive has done quite well in the global equity space. The disadvantage is once certain constituents or shares underlying that index itself, you can't actually change, and neither can the portfolio manager because there's no one on the other side. So you can have moments in the market cycle where you're actually highly concentrated to a specific share. And this is converse to an active management strategy. So right now, you'll find that a lot of passive global equity trackers actually have a lot of Mag 7 allocation. You'd find that some active managers...
Magnificent 7.
Magnificent 7. So those are the stocks... Magnificent 8, with you included. So the Mag 7 is, of course, the stocks that have done tremendously well and driven the performance of the global equity market last year. However, a lot of actively managed funds or active portfolio managers are quite scared and are quite cautious around where valuations and share prices of these stocks actually are. And so you'll see a lot of them actually have moved away in terms of their allocation to these stocks. What I would say are advantages to an active strategy is you're actually getting a portfolio manager who knows what they're doing, constantly monitoring the movement and the valuations and the outlook of the funds, of the stocks that are actually within the constituents or the universe that they can actually invest in. The converse to the trackers, which are quite cheap, is that actively managed funds are slightly expensive relative to passive stocks. So what I would say is during market highly volatile periods that investors should actually consider blending the two. So have an active and passive strategy where your active manager will have a lot less, Mag 7 allocation in their strategy, such that when the Mag 7 stock starts meeting the intrinsic values and investors start dropping them, you're not overexposed to that market, and the portfolio managers will manage that risk for you on your behalf.
David, I'd like you to come in. Let's talk about 222. I don't know if you've got these numbers, but I trust you've got numbers in your head. 2022 markets came off. How much did passive stocks come off because of the high concentration? Did they come off more than the general market?
We're talking about a few percentage. It's like saying, did my team lose 5-0 or did it lose 6-0 or 7-0? It doesn't matter. They still lost.
Yeah.
So to a large degree, it's very difficult to make those kind of comparisons. And there's so many different funds. Generally, the market was down. I think what Lutanda's saying is that if the market goes up, you might not make as much as a very active manager, but your risks are far less. You know, and if there is a sudden crack in one of these shares, which can happen, you know, if we look at the market now, you know, I'm a big NVIDIA fan. I'm a massive NVIDIA fan, and I still like the stock, even now as we talk, despite the fact, what happens is something can go wrong. Maybe a competitor comes, etc., and a share like that can tumble fast. You know, it can. In that case, you'll be far better suited in a passive investment, in a better balanced one, than say directly to a company like this. Because what happens when those Mag 7s, those magnificent 7s start moving, they start to increase percentage-wise in your portfolio. So there are risks which have to be managed.
And you don't talk about the Magnificent 7, you talk about the Magnificent 20. It's not just tech stock, there's luxury goods, there's healthcare, there's pay systems and all those type of things.
I'm very heavily leaning towards tech, but I also like the weight loss drugs at the moment. I think there's, you know, when they make headlines all the time, I'm very heavily in luxury. I love Ferrari, I love LVMH, I love the strategies that they're in. You know, this is not, I love the strategies that they're following in those. So I've got quite an array, but I don't try go more than 20 odd stocks.
Well, Dave, I like the way you practice what you preach, because I like when your wife gets into your Ferrari with a Louis Vuitton bag. I love to see it. Then I say, David, believe.
You have to listen. Bryan knows that. I always say, buy the shares, not the product.
I love it. I'm taking that with me.
David, Jerome in Sea Point said, I would imagine that South Africa is falling out of favour with America because it's starved for Israel. What trade benefit does AGOA provide? And if South Africa is excluded, what impact will it have on our companies reporting to the USA? Anything major?
You know, it's a difficult one, this one, because we're talking about AGOA. That's the, you know, it's a favoured trade agreement. Nothing's been done there. And the one thing is that America are very nervous to exclude South Africa. In other words, to isolate them. Simply because, as we knew, you know, we're a lot older than you, so we know from the Cold War what used to happen there is that there was always the fear that Africa or African nations, you know, would play both sides, both the Russians and the Americans. If you don't give us money, we're going to the Russians. If you don't give us money, we're going to the Americans. And I think America doesn't want to isolate itself. So I don't think anything will happen on those trade agreements, despite the fact that there's a lot of geopolitics taking place and so on. The other thing is that from the South African market, as we mentioned earlier, there's very little exposure to the South African economy on the JSE. Regardless, you know. So I don't read too much into geopolitics.
Good. Lutanda, a question from Marcus in Westcliff. He says, what currency would you advise that I invest in with my offshore funds? This is a question that people are sitting with sterling, so they think, I'll invest in sterling, others in dollars. And it really doesn't make a difference, does it? Because you're not going to put all that currency into equities. You're going to put it in global equities.
100%. And I think if the client is actually asking that question from a fund domicile perspective, so what domicile currency is the fund that they're actually looking to invest in, what they also need to consider is a lot of funds on these investment platforms in the South African context are actually available in US dollar. So you'll find that some of the allocation that you're looking for won't be available through a sterling domiciled fund. So you're quite limited in that perspective. The other way to look at it is a lot of the fund managers that actually are hedging out currencies, so they're using currency derivatives to actually hedge out some of the risk of their portfolios, are actually long the dollar. So there is a lot of strength and conviction towards the dollar, both in terms of fund management techniques, in terms of hedging out the currency risk, but also in terms of fund availability. So I would say possibly over the long term, look at the US dollar.
David,
I agree.
Whatever currency you get, I would imagine a bigger percentage is going to be buying stocks that are listed in the UK, in the US, but they're all global companies.
They're all global.
The fact that they're listed makes no difference.
Dead right. The only problem is that in Europe you haven't got an equity culture. What I mean by an equity culture, I've never heard of a German hedge fund, you know, or they're very socialistic, Europe, and you know, the state looks after them, and therefore they always invest in bonds and very, you know, high fixed interest kind of products and so on. So even good companies there trade at a much lower PE than in America. America's an equity culture. So for the wrong reasons, because there's some really good European businesses. So I still think the dollar will dominate. You know, it is going to dominate, and the best companies are still in America. And I think we're going to have a decade of American dominance simply because of the Apples and the Amazons and the Alphabets and the Nvidias and all these huge businesses which are just flush with cash and very, very strong financially. So you're not going to topple those businesses, especially, you know.
I'm going to make your life easy. I'm not going to ask you for predictions what happens in South African elections, nor the UK elections, nor the US elections. My question to you, which is a much simpler one, where's the rand going?
Oh no, Bryan.
Well, I'll give you a simple question. Hey, Dave, where's the rand going, Latanda?
Call a friend.
You know what? I think the rand's going to get stronger for whatever reasons. Politics is not going to play a role. And the reason is that the dollar will come under pressure as their rates start to fall. And remember, I think rates in Europe and the UK will come down as well. But I think that as things improve, so the rand, I see the rand 1750, 70. For whatever reason, not because of South Africa, but rather because I think the dollar is going to come under a bit of pressure as equity markets go. So the problem is, and this is the thing we always discuss, when do you take your money out? And when do you buy? And that's your conundrum. Because while the rand's going down, while the rand's improving, equity markets are going up. So you've got that swing.
And Dave, both of them are long term.
Yes.
If you take the rand out at 1770 or 1830. I'm sorry we've run out of time, but it's lovely having you on, Latanda. And David, thank you as always. One of the more important tasks that investment managers undertake is to try and find value in global stock exchanges. They need to evaluate the difference between the price of a share and the actual value of the business. Share prices will fluctuate. However, the underlying value of the business could be increasing as their profits increase on a year-to-year basis. The success is to buy when investors are negative and the intrinsic value of a share looks cheap. To you, the investor, you may read it differently. However, the expertise one needs to respect and have confidence in your portfolio managed decision. Latanda, David, thank you for joining me this evening. It's important to note our program is to provide information and should not be construed as advice. Next week's program, we'll be dealing once again with estate planning, and if you need to get hold of me, my details will appear on the screen. I'd like to thank you for watching, and good night.